Welcome to The Explainer. Today, we're putting on our professional sell-side equity analyst hats to conduct a rigorous, fully documented analytical autopsy of Veritone, a stock trading under the ticker VER. When evaluating a stock in severe distress, we can't rely on gut feelings or hype. We need cold, hard data. We're going to build a full stock valuation directly from the source financial metrics, applying a whole suite of classic valuation models to see if we can uncover true intrinsic value beneath the surface. All right, here is our game plan to uncover VERI's true intrinsic value. We're going to hit the financial profile, run a discounted cash flow analysis, look at dividend and residual income models, check out relative peer valuation, evaluate asset-based valuation models, and finally, deliver our intrinsic value verdict. Let's get to it. Section 1. The Veritone Financial Profile. Kicking off our patient intake. This single number really hits you over the head with the severity of the situation. Over the last 52 weeks, Veritone has suffered a catastrophic drop of negative 77.07%. It plummeted from a high of $9.42 down to just $2.16 today. Now, when you see chart destruction of this magnitude, the immediate question you gotta ask is, do the underlying fundamentals actually warrant this kind of punishment? And here is where it gets really interesting. Look at the stark contrast between top-line survival and bottom-line collapse. Veritone actually boasts a very healthy gross profit margin of 68.80%. That means their core operational costs are relatively low. But once you factor in operating expenses, debt, and corporate overhead, the net profit margin completely craters to negative 62.75%. So they're generating nearly $90 million in revenue, but essentially burning it all away the second you step below the gross profit line. These next metrics really build the narrative tension here. Over the trailing 12 months, Veritone's free cash flow is a painful negative $58.18 million. And their return on invested capital, it's a staggering negative 73.38%. Think about that. For every dollar of capital pumped into this business, they are actively destroying value. So we have to ask ourselves, what is a company bleeding this much cash actually worth? Section 2. Discounted cash flow analysis. Okay, the DCF. This is our first real diagnostic test, discounting expected future money back to today's present value. Now, conducting a rigorous DCF requires a cost of capital and projected growth rates. Because our source data lacks a WACC or forward projections, we as analysts have to explicitly declare some sensible assumptions to make this work. Given Veritone's extreme price volatility, I'm slapping a highly punitive 12% discount rate on this to reflect the sheer risk. And for the terminal growth rate, we're going with a sensible default of 2%, basically aligning with long-term inflation. But here's the kicker. Even with those parameters built, the model just hits a brick wall. When your starting trailing 12-month free cash flow is negative $58.18 million, and your net income compound annual growth rate over the last 3 and 5 years is dead flat at 0%, projecting future cash flows just becomes an exercise in projecting continuous losses. If you discount consistently negative cash flows back to present value, you get a theoretical intrinsic value of 0, or honestly, less than 0. Basically, this model completely fails to find any current equity value unless you inject some heroic, speculative turnaround assumptions that simply aren't in the data. Now, normally, a good analyst would pivot right here to an adjusted present value, or APV, or maybe a sum of the parts model. APV is fantastic when debt levels are fluctuating because it values tax shields separately, and SOTP is great for complex businesses with varied segments. But we have to skip them. Why? Because the source documents completely lack the required segment reporting, independent segment margins, and debt shield specifics. Simply put, we can only value what we can actually measure. Section 3. Dividend and residual income models. What's fascinating here is how incredibly fast we can just disqualify certain absolute models. Take the dividend discount model. It requires a company to have a consistent, stated dividend policy. While looking at the metrics, Veritone's dividend CAGR is exactly 0%. No history of payouts whatsoever. So it's an instant pass-fail test. Since VERI pays absolutely no dividends, the DDM is entirely inapplicable. Moving on. So we turn to the residual income model instead. This model starts with the current book value of equity per share and adds the present value of future residual income, basically the income generated above the cost of equity. We see Veritone trades at a price-to-book ratio of 2.94. However, the reported return on equity is an astonishingly low negative 167.48%. Let that sink in. Under this model, if you apply an equity charge against an ROE that deeply negative, it completely destroys any residual value from the book equity. Once again, the math points us straight towards zero. Section 4. Relative peer valuation. All right, since the absolute valuation models are brutally punishing Veritone's cash burn, let's pivot to relative multiples. Let's see if the broader market offers any hope. First, we need to explicitly flag an external assumption here. The source text doesn't actually identify specific comparable companies. So, to make relative valuation work, we're assuming a baseline comparison using general tech and software industry averages, just to see if Veritone is trading at a discount. Now, at first glance on the top line, the metrics suggest the stock might actually be cheap. A price-to-sales ratio of 2.24 and an enterprise value-to-sales ratio of 1.93? That's pretty low for the tech sector. But you gotta dive deeper. The PE ratio is negative 1.19 and EV to EBITDA is negative 3.07. Because the company is actively bleeding money, standard earnings-based relative comparisons become mathematically impossible. I mean, you literally cannot multiply a peer group's positive PE average by Veritone's negative earnings to get a target price. It just doesn't work. Section 5. Asset-based valuation models. So, when cash flow is negative, dividends don't exist, and earnings multiples are totally broken, analysts turn to the ultimate fallback, asset-based valuation. Basically, net asset value and liquidation. What happens if we just sell off the parts and pay the debts? Well, the crucial point here is that Veritone's current ratio and quick ratio both sit at a weak 0.71. Anything below 1.0 means short-term liabilities completely outpace liquid short-term assets. This severe lack of immediate liquidity heavily impairs any theoretical liquidation value, because short-term creditors would immediately swallow up whatever cash is generated. Section 6. Final Intrinsic Value Verdict. All right, we've run the gauntlet. We've applied absolute, relative, and asset-based models to the data. And honestly, the verdict is undeniably harsh. The DCF implies zero or negative value because of that negative $58 million free cash flow. DDM, SOTP, and APV models can't even be run due to data constraints. Any residual income is decimated by a negative 167% ROE. Relative earnings multiples are broken, and asset liquidation is completely blocked by poor short-term liquidity. Based strictly on the provided source data and rigorous financial modeling, the intrinsic values simply cannot justify the current $2.16 price, not with some massive, highly speculative turnaround assumptions. So I'm going to leave you with this provocative thought as we wrap up this explainer. In the world of finance, metrics represent the past and the present, not necessarily the future. Are these disastrous metrics a permanent, terminal condition for Veritone? Or, given that solid 68% gross profit margin we saw right at the beginning, is this just the darkest hour before a dramatic management restructuring and recovery? When the numbers say zero, the market is pricing in hope. Whether you buy into that hope is the ultimate question. Thanks for joining me, and keep questioning the data.